Hello, my name's Ian Stewart. I'm the Chief Economist at Deloitte. What I want to do is take you through the findings of the third quarter survey of Chief Financial Officers, looking at the most important charts from that survey and thinking through the messages that we've got from CFOs in the third quarter. Now, what we've seen in this latest survey is a really pronounced rise in Chief Financial Officers' perceptions of external uncertainty. So what we're looking at here is the percentage of CFOs who see external economic and financial uncertainty as being high. And it's actually risen at the fastest rate in the 5-year history of this particular question. And I think what's happening is that the big sell-off we've seen in equity markets in the last 3 months, UK equities down 18%, the continued slowdown in emerging markets in general with a particular focus on weakness in China, that's all feeding through to create a sense of greater uncertainty in the economic environment for Chief Financial Officers. And this really does matter because you can see from the chart that here in 2013-14, as perceptions of uncertainty declined, actually at the same time we saw a rise in risk appetite and a willingness to spend. So when CFOs see more uncertainty in the environment, they tend to pull in their horns, they tend to become more defensive. Now, that is exactly what's happened. Every quarter for the last 8 years we've asked CFOs about whether now is a good time to take risk onto their balance sheet. And the ups and downs of this series on risk appetite, the blue line here, really does capture the big movements in the economic cycle from the eve of the financial crisis onwards. And what's happened is that in the latest survey, risk appetite has declined and it's back to levels that we were seeing back in sort of 2012, 2013. Now we've plotted it on this chart against the green line, and the green line actually shows the performance of equities, of shares, against the performance of bonds. And generally, the story here is that when institutional investors are making bets on equities, when they're buying equities and selling government bonds, so they're buying a risky asset and they're selling a safe asset, as they were in 2012 and 2013, that tells you that CFOs will generally want to take risk, and that's exactly what they did. And you can see that the latest decline in risk appetite amongst CFOs has coincided with institutional investors reducing the amount of risk they're taking. So they've been tending to sell equities and buy a relatively safe asset, government bonds. So what we see from this chart is actually sentiment in financial markets and in the corporate sector move very closely in tandem. Now, in a sense, this decline in risk appetite shouldn't come as too much of a surprise. It's been a turbulent time for financial markets. This chart is of the so-called VIX index. In America, it's sometimes called the fear gauge. It's an index of equity market volatility. And I think the way to interpret it is that these big spikes are associated with greater risk, greater uncertainty in financial markets. So this one was a result of the failure of Lehman and the onset of the financial crisis. This one coincided with the beginnings of the euro crisis and worries about America and its ability to service its debt. This one coincided with the first Greek crisis. And of course you can see from the latest reading that actually we've had in recent months quite elevated levels of uncertainty as measured by the VIX index. So that nervousness in financial markets really has been translated into the corporate sector. And what's quite interesting about our survey is that when you compare the optimism of corporates with the optimism of consumers, as we've done on this chart, it's really quite a different story. You can see that business confidence has fallen, the blue line, whereas actually consumer confidence has fallen a little bit in September, but it's close to the 15-year peaks that it got to in August. And actually what we've seen in the survey is that although CFOs are worried about the external environment, they're actually pretty positive on the UK economy. They see the strength of the UK economy as being one of the factors which is supporting their investment plans. So I think part of the story that we're getting out of our survey is that external risk is affecting perceptions of opportunity in the wider world, even though CFOs are quite positive on the UK economy, and actually UK consumers have been pretty strong in recent months. Now, every quarter we produce a hierarchy of CFOs' worries, and of course these change quarter by quarter. And what's interesting about the latest list of worries of CFOs is at the very top is the prospect of higher interest rates in the US and UK. So although the second biggest worry is volatility and weakness in emerging markets, and that's a much more pronounced worry. It actually scores the same level as worries about weakness in Europe, where there's less concern. That the top worry is still the prospect of higher interest rates. And the reason I think that's interesting is that CFOs are worried about growth. They think they see downside risks to growth in emerging markets, but they are as worried as they were 3 months ago about the prospect of higher interest rates. And to me that says that although central banks like the Federal Reserve, like the Bank of England, have been trying to reassure corporates that interest rates will probably stay lower for longer in this environment of greater uncertainty, that hasn't really fed through to how CFOs feel. And we're also interested to understand not just how do CFOs feel about the world, what do they think about risk. We also want to understand how they plan to run their business. This chart just shows the priorities for CFOs over the next 12 months. And what's interesting is there hasn't been any dramatic move, but there's been a subtle shift away from expansion and towards a rather more defensive stance on the part of chief financial officers. So for instance, there's been a slight decline in the willingness to do capital expenditure or to expand by acquisition. And conversely, there's a rather greater focus on reducing costs. So I think what we're seeing here is that elevated uncertainty and a fall in risk appetite is translating itself into a slightly more defensive stance on the part of CFOs. We also asked them, what do you think is going to happen to hiring, to capital expenditure, to investment, and to discretionary spending? And we had very strong readings on all of those a couple of years ago, but there has been quite a pronounced decline over the last couple of quarters. And that fits with the idea that corporates, as they see greater risk in the external market, they're kind of pulling in their horns. They're looking to conserve resources. They're rather more cautious about spending. I guess we might as well end on a positive note, and that is that although there's turbulence in financial markets, CFOs are telling us that they still see extremely favourable financing conditions. So when we ask them about the availability of credit, it's close to its best it's been in 8 years. If we ask them about the cost of credit, this blue line here, it's very, very low. So this is still an environment where for big corporates they've got great access to credit. They're still benefiting from very low interest rates. Of course, they're worried about the prospect of higher interest rates in the UK, and they're also worried about the effect of weakness in external markets. I think pulling this all together, what it means is that this is really the first very strong evidence of an effect on corporate sentiment in the UK from external risk. I think in an environment in which demand in emerging markets is flagging somewhat, where the pound has been strengthening, we can probably count less on exports to drive the UK's recovery, and it's probably going to mean that growth is going to have to come more over the next year or so from consumer spending.